All right, future chartered accountants, welcome. If you're gearing up for your CA Inter exams and AS14 on amalgamations is on your list, you are in exactly the right place. We're going to completely demystify this standard today so you can walk into that exam hall feeling confident.
Okay, let's jump right in with a classic exam-style question. Imagine you're in the exam hall, the clock's ticking. You're calculating purchase consideration. You see a payment made to the debenture holders of the selling company. Do you include it? Yes or no? Think fast.
And the answer is a hard no. Now, if you said yes, don't worry. That is probably the most common trap that ICAI sets in AS14 questions. The whole point of this session is to make sure you can spot these traps from a mile away and never lose marks on points like this again. First things first. Every single amalgamation problem you will ever face begins with this one fundamental question. You have to decide, are we looking at a merger or are we looking at a purchase? Your answer here dictates everything else you do. Let's just quickly nail down the vocabulary. Amalgamation is just a fancy word for combining companies. The company that's being taken over is the transferor. Just think of it as the selling company. And the company that's doing the buying is the transferee. Transferor sells, transferee buys. Simple. Now, this is absolutely crucial. These are the 5 commandments of a merger. For an amalgamation to be called a merger, it has to satisfy all 5 of these conditions. Not 4, not most of them, every single one. This is a very important area, so let's be clear. All assets and liabilities must be transferred. 90% of the old shareholders have to become new shareholders. The payment must be in equity shares. The old business has to continue, and everything must be recorded at book value. And here's the best part. This test is totally black and white. There is no gray area. If all 5 of those conditions are met, boom, you've got yourself a merger. But if even one, just one, of those conditions fails, it's immediately classified as a purchase. It's that straightforward. So what happens next? Well, once you've made that critical decision, merger or purchase, the accounting standard forks into 2 completely separate roads. Your choice of road depends entirely on that first decision. And here are those 2 paths. If it's a merger, you use something called the pooling of interest method. The name says it all. You're literally just pooling all the assets, liabilities, and reserves together at their old book values. But if it's a purchase, you use the purchase method. This reflects the reality that one company is actually acquiring another, so you can revalue the assets and liabilities to what they're truly worth today. Okay, let's get into this section with all the numbers. This is where the most calculations happen and honestly where ICAI loves to hide its trickiest questions. We're talking about purchase consideration, or PC. Please pay very, very close attention to the wording here. Purchase consideration is what the buying company pays specifically to the shareholders. I'm going to say it again because this is where marks are lost. It's what's paid to the shareholders of the selling company, not to the company itself, not to its creditors, and absolutely not to its debenture holders. Only payments to the equity and preference shareholders count. And this slide right here is your golden rule. This is a massive ICA trap alert. You include everything paid to the equity and preference shareholders. Doesn't matter if it's cash, shares, or something else. And you always exclude payments to debenture holders and any of the legal or liquidation costs. This is the direct answer to that poll question we started with. Let's make this real with a quick example. So A Limited is taking over B Limited. It pays the equity shareholders with shares worth $4,20,000. It pays the preference shareholders $1,87,000, and then it separately handles the debentures of B Limited by converting them into new ones. So, what's the purchase consideration here? It's simple. You take the $4,220,000 for equity shareholders, add the $187,000 for preference shareholders, and you get a total PC of $607,000. And the debentures? As this official note from the material says, payments to debenture holders are not covered. This is a guaranteed mark in the exam if you just remember this rule. All right, so we've figured out the PC, and we know which accounting method to use. But what do we do with the seller's existing reserves and the P&L account? And what happens if goodwill or a capital reserve pops up? This part really impacts how the final balance sheet looks. Look at this stark difference here. In a merger, because it's just a pooling of interests, the reserves keep their identity. General reserve from the old company just becomes general reserve in the new company. But in a purchase, those old reserves, they just vanish. They lose their identity and are not carried forward.
except for one huge, very important exception that ICAI just loves to test.
And here it is. This is a critical exam tip. Even in a purchase where you normally wipe out reserves, you cannot get rid of statutory reserves. These are reserves created to comply with a law, like the Income Tax Act. You have to preserve them because the law says so, and an accounting standard can't override the law.
So how on earth do you account for this? It's a little weird, I'll admit. You have to show the statutory reserve on the credit side to keep it alive, but the corresponding debit entry goes to a brand new special account called the Amalgamation Adjustment Reserve, which shows up as a negative number. This peculiar presentation is a favorite area for ICAI to twist a question.
The treatment for the profit and loss account follows the same kind of logic. In a merger, you simply add the two P&L balances together. But in a purchase, the P&L balance of the selling company, whether it's a profit or a loss, is just gone. It loses its identity and is not recorded in the books of the buyer. Now, goodwill. This usually only shows up in a purchase. It's basically the premium you pay, the amount of PC that's over and above, the value of the net assets you're getting. You treat it as an asset, and you have to amortize it. The key rule for your exam is the time period. You should prudently write it off over a period not exceeding 5 years, unless you have a rock-solid justification for a longer period. We are on the home stretch now. We've done the tough calculations and accounting entries. Let's finish up with the theoretical bits that can still get you easy marks, the disclosures you need to make in the financial statements. The disclosure requirements are pretty logical. For any amalgamation, you have to state the basics: the names of the companies, the effective date, and which accounting method you used. Then for merger specifically, you give details on the share exchange. And for purchases, you need to detail the consideration and explain your treatment of any goodwill or capital reserve. Now, this is a fantastic question that links IS-14 with another standard, AS-4. What if the deal goes through after your balance sheet date, but before your accounts are approved? Do you change the numbers? The answer is no. You should not incorporate it, but you must disclose the details in your notes to accounts because it's a major event occurring after the balance sheet date. And let's end with this final thought. We've seen two very different methods: pooling of interests, which carries forward old historical book values, and the purchase method, which uses current fair market values. So the big question is, which one do you think is a better, more honest picture of the new company's financial health? There's no easy answer, but it's the core debate behind this entire standard. Something to think about.